Good afternoon, everyone, and thanks for joining us today for the discussion of the World Bank's Global Economic Prospects Report. I'm very pleased to be here. And I'm Bob Fay. I'm the Managing Director of our digital economy work at the Center for International Governance Innovation, or CG, as many of you know it as, which is a public policy research institute located here in Waterloo. And we're pleased to partner with the Balsillie School today to host this virtual event. So today we're welcoming a Waterloo and Balsillie School graduate, Justin Damien Guinette, who's a senior economist in the prospects group of the World Bank. So JD and I actually worked very closely together at the Bank of Canada in the International Economics Department, where he did many things, including he finished as director of the International Model Development Group before he went off to the World Bank. He was a pleasure to work with. He did excellent work, and I'm sure that's in part due to his training as an economics grad at Waterloo and the Balsillie School. So today he's going to talk for about half an hour. And please use the Q&A chat to throw in questions, and I'll gather those questions as they come in. And when he's done his presentation, I'll start with maybe a few questions of my own, and then we'll bring in the questions from the chat. So let me now introduce JD. JD, the floor is all yours.
Thanks, Bob. It's really a pleasure to be here today. It means a lot to me personally to be presenting at CG. I had the privilege of attending many of these Friday-type seminars as a global governance student several years ago. I distinctly remember the sandwiches from Vincenzo's, which were an integral part of my graduate study experience at Waterloo. So today I'll be speaking about the Global Economic Prospects Report. So I'll present the highlights. And for those who are not familiar with the Global Report, it's one of the World Bank's flagship corporate reports. So in this document, we're articulating the bank's views on the global economic outlook. We're analyzing important macro developments, and we're providing actionable policy advice for policymakers, especially to those in emerging markets and developing economies, which we call EMDEs for short. So in this JEP edition, we review the usual global and regional outlooks over the next couple of years. In addition, this particular version essentially takes a long view in two dimensions. First, we're asking the question, what are the implications of the pandemic for growth over the next decade? And then what are the long-term challenges caused by some of the unprecedented fiscal and monetary policy stimulus that we saw put in place last year? So in the next 30 minutes, I'll guide you through the report's main findings through four questions. So what are the near-term prospects? How has COVID-19 increased debt-related risks? How has it worsened growth prospects for the 2020s? And finally, with all of that in mind, what are the policy priorities going forward? Let me start with the growth prospects for this year and the next. So we've all seen the sharp resurgence of the pandemic in the past couple of months. It's materialized, in varying degrees across the world, especially present in advanced economies, but also in certain emerging market regions, such as the Latin America and Caribbean region, and then Europe and Central Asia. We've had very good news on the vaccine development front. But realistically, in the face of this resurgence, many countries have had to impose lockdown measures that they had started to relax during the summer last year, which allowed for quite a strong initial rebound of activity to take place. And this cycle should be fairly familiar by now in terms of the pandemic flaring up, pandemic control measures are put in place, mobility declines, activity declines, cases come down, there's a relaxation of some measures, and then the whole cycle starts up again. And it's likely to continue this way until we have a durable end of the pandemic, which is a promise held by the very effective vaccines that have been developed very recently. And although these pandemic control measures we're talking about have become more targeted and less economically disruptive, these measures are still going to weigh on growth in the near term, right? And this is one of the reasons why our projections are lower than other projections from international organizations that were released earlier last year. And these lockdown measures are also reinforcing what we see as a two-track recovery in the data. So both charts here show the different sectoral effects of the ongoing pandemic. So faced with pandemic restrictions, households have substituted consumption towards goods. And this has driven what we've seen as a rapid recovery in global retail sales, industrial production, and the trade in goods. So for example, by October, global goods trade exceeded its pre-pandemic level, despite falling about 15% in March and April last year. And as you can see in the chart on the left, this is a much stronger bounce back than we would have seen during a similar time period during the global financial crisis that occurred in 2009. The recovery in the goods sector, along with an investment-led recovery in China, has also been very good for industrial metals, which you can see in the chart on the right. So that's also part of this good story. Now, in contrast, the global recovery in services has been very subdued, right? And we've seen mobility come down with the introduction of these new measures more recently. So services trade, which is on the left here, all still depressed, still about 10% below pre-pandemic trends, despite some recovery last summer. And the recovery in oil prices that we've seen is essentially predicated on deep supply cuts on the OPEC front. Right? Underlying this, we have oil demand being deeply depressed because 2/3 of oil demand is essentially travel and transportation. And we're not going to see that rebound in a durable fashion until we have the pandemic behind us and people are traveling again. And one thing to note is that all these developments would likely have been much worse had it not been for a remarkable improvement in financial conditions that we saw last year. So let's put ourselves back in March for a moment. So March of last year, it's kind of the beginnings of that first wave that caught everybody by surprise. We essentially had the global economy teetering on the brink of a financial crisis. There was a sharp tightening of financial conditions. And you can see that in the chart on the left. So not quite as much as what we saw at the height of the global financial crisis, but remember that global financial crisis was first and foremost a financial crisis, versus here we're talking about a severe health shock with macroeconomic implications, still leading to a severe tightening of financial conditions. So in a way, policy came in and saved the day, right? It ushered in a remarkable period of sustained easing with falling borrowing costs and rising equity valuations. And when I say policy here, I mean an aggressive initial monetary response followed by a fiscal response that was also quite unprecedented. It's remarkable to think that with global output still significantly depressed relative to 2019 levels, pre-pandemic trends, global financial conditions have ended the year 2020 in better shape than they were, before the pandemic. And on top of that, even better than a similar period at the same time following the global financial crisis. The improvement was also broad-based. We've seen a stunning evolution of the sovereign and corporate debt issuance in EMs, which has exceeded its 2019 levels throughout the year of 2020. This is not usually what we see in periods of severe financial turmoil. But a lot of that EM development masks vulnerabilities. We've had debt levels rise sharply, and banks' balance sheets have also weakened. So the natural question is, putting all that data together, what do these developments mean for growth prospects for this year? Well, they essentially mean the prospect of a subdued recovery and one that has deteriorated over the past 6 months. We now expect global growth to be about 4% in 2021. That may be more than global potential growth, so it marks a cyclical rebound of sorts, but it's nowhere near enough to reverse last year's severe output losses. Essentially last year with the 4.3% contraction in output, we're looking at the deepest recession since the Second World War. Advanced economies are expected to follow a similar pattern. We expect growth to rebound to 3.3%, but again, this is less than what we had penciled in 6 months ago. And it's nowhere near enough what will be needed to offset the 5.4% contraction we saw in 2020. One thing to note is that these downgrades really reflect that resurgence of the pandemic that I was just presenting in an earlier slide. Now, for emerging markets, we have a relatively strong rebound to 5% growth in 2021. Wouldn't it be nice? We have the first outright contraction in EMs in our recorded history on the macro front, right? And then we have this strong bounce back to 5%. Well, it's not as neat as it looks in the sense that that emerging market and developing economy aggregate includes China, which is an exception here and experiencing a very strong rebound, which we expect to be 7.9% growth in 2021. If you take that out of the equation, we're looking at EM ex China growth of around 3.4% next year. And that's below its long-term average of 4.1% over the past 2 decades, and nowhere near enough to make up for the 5% contraction for those countries in 2020. So for about 2/3 of EMDEs, or emerging market and developing economies, the outlook for 2021 is now weaker than it was 6 months ago. And then if we think for advanced economies, by the time we finalized our forecasts in mid-December, we had downgraded growth forecasts for the year ahead for almost 90% of advanced economies. And even that, if you think of where we started in June, we were below other forecasters at that point, right? So not only were we pessimistic then to some extent, but the evolution of the pandemic has really reinforced the downside risks associated with this very difficult shock. So one of the reasons that we've seen such heavy economic damage from the pandemic are the sharp investment losses. Investment growth in EMDEs other than China essentially collapsed in 2020. They collapsed by about 11%. And that's 4 percentage points more than what we saw during the global financial crisis. And this basically builds on a decade of persistent broad-based investment weakness, which is, by the way, not just a EM phenomenon. This is a global phenomenon. Both advanced and emerging have experienced weak investment growth throughout the decade. So, of course, we were expecting some bounce back, right? And this is part of our outlook, the fact that activity rebounds with some containment of the pandemic in the coming years. That said, it will not be an investment-led recovery. Investment will struggle to recover. Forget coming back to pre-pandemic trends. In our forecasts, if we look at emerging markets excluding China, investment is set to be lower than what it was in 2019 by about 2% in 2022, let alone coming back to where we would have expected pre-pandemic. And this will have important long-term consequences. And meanwhile, if we go through the risks to this outlook that I presented, they are essentially tilted to the downside. And what I mean there is that there's a greater risk that growth might turn out to be weaker than we expect, than the possibility that growth might surprise to the upside. There are several risks that could derail the short-term recovery from the crisis, and there's many other risks that could essentially lead to a decade of lost growth. And I'm not going to read you through every single item on this list, but let me touch on the evolution of some of these risks over the past several months. One thing that's very important is that several months ago, we were really thinking about the risks associated with vaccine discovery and development. And I think we've been pleasantly surprised on that front. But those risks have basically morphed into vaccine delivery risks. So everything associated with the production, the logistics, everything associated with distribution and vaccinating so many people, which we're talking the vast majority of the world, is the target over a very ambitious timeline. And also in the short term, because of the resurgence in the pandemic I presented, risks about an intensifying and prolonged pandemic have also increased. Some other risks have declined in prominence. So for example, the risks of broad-based trade tensions has receded, and also the risks of another commodity price plunge seems less likely at this point in time. So one thing that we've done in this report, and I was personally involved in this endeavor, was formalizing some of these risks in the sense of building particular alternative scenarios to illustrate what the world could look like. And really here we focused in on thinking about delays in bringing the pandemic under control, and also the possibility of acute financial stress. So we've developed 3 scenarios in addition to the baseline scenario that was presented in the outlook table I showed you. And just to recap, so in the baseline scenario, this rebound in global growth is predicated on social distancing and a constellation of pandemic control measures put in place by governments, essentially turning back the tide of the pandemic in the first half of 2021, and then widespread vaccination being achieved in advanced economies and major EMDs sometime in the second half of 2021. Now, all of that basically gaining a better handle on the pandemic, allowing governments to finally, in a durable fashion, relax some of these lockdown measures and mobility restrictions, allows global growth to bounce back to 4% in 2021 and then 3.7% in 2022. But global growth could be much weaker, could be less than half that rate in our downside scenario, which is would be 1.6%. In the event that the pandemic proves much more difficult to control and lingers for longer, and vaccination proceeds at a much slower pace. This is the downside scenario that we have. And one thing to note on the emerging market front, the regions that would be most hard hit would be those that are reliant on tourism and industrial commodity exports. So specifically the Latin America and Caribbean region, the Middle East and North Africa, and Sub-Saharan Africa. In an even more severe downside scenario, we could see global growth negative for a second year in a row. In this case here, we're talking about the possibility that we have a downside case for the pandemic. And that just leads to a continued accumulation of financial stress and financial vulnerabilities to the point where authorities cannot intervene successfully to quell the stress. If that were to be the case, we could have widespread bankruptcies and sharp deteriorations in bank balance sheets, ultimately leading to a financial crisis. Now, I don't want to be all doom and gloom in this case. There is the possibility of an upside. And this is very much policy fueled on the pandemic front. So if governments are able to quickly get a handle on the pandemic and follow up with prompt, widespread vaccination of their populations, we could see global growth bounce up faster, basically reach an average of almost 5% over 2021 and 2022. So the impact of the pandemic would have been much worse had it not been for all the policy stimulus that was put in place. But the unprecedented policy stimulus has repercussions. Debt burdens have increased significantly, and unconventional monetary policy stimulus that was put in place in EMs raises new risks. So the combination of the collapse in output that we saw in 2020 and the unprecedented fiscal stimulus efforts have caused another surge in global debt. You can see that very clearly in the picture on the left here. And if we think about global debt, and break it down into government and private, if we look at government debt first, alone it's increased 16 percentage points of GDP in 2020 to a record 99% of GDP. In advanced economies, government debt is up by 20 percentage points in 1 year alone. This is the single highest increase in 1 year since 1970. And the debt to GDP ratio is up by 9 percentage points in EMDEs. Now, this is less than advanced economies, but it's still the largest annual increase since 1987, when many of these economies were essentially dealing with debt crises. And the reasons that the amount was not as large is in part because of fiscal constraints due to previous debt accumulation in many of these economies. I'm sure several governments would have wanted to be able to borrow more and put out more stimulus to deal with the very severe macroeconomic shock caused by COVID. Now, government debt has also increased substantially in low-income countries, right? With several of which are now at risk of debt distress amid a collapse of government revenues and a steep rise in spending pressures. Now, if we turn to private sector debt, we don't have that much official data available now, but what we do see from what we can observe is likely a surge on the private sector debt side as well. And that's a bit of a no-brainer in the sense that a lot of the policy response that was put in place during the height of the pandemic in 2020 was really meant to prevent a damaging deleveraging cycle on the corporate side. So basically a lot of these policies are allowing firms to continue to borrow despite the hard times. Now, all of this extensive debt accumulation that we're talking about for 2020 is coming on top of a record high increase in total debt since 2010. So at about 7 percentage points of GDP per year, right? This is the fastest debt buildup that we can observe over a decade since the 1970s. And if you're interested to learn more about the history of debt accumulation, we've done quite a detailed study on this. We released a book in December 2019 on global waves of debt. So that's the past. Now, if we look to the future, we can hope for a stabilization on the EMD ex-China debt front of around 60% of GDP. But this will be predicated on a durable growth rebound and multiple years of fiscal consolidation after the extraordinary expenditures that we saw in 2020. Now, if this occurs, right, this would be unusual by historical standards. We don't observe other episodes where we have a global recession and then debt ratios and EMs essentially stabilize the next year. Usually debt continues to mount. And the bottom line here is that higher debt loads and weaker growth will significantly erode debt service capacity for years to come. Now, last year, we also saw unprecedented monetary policy stimulus in advanced and emerging markets. And this raises its own set of issues, especially on the EM front. So as of mid-December, 18 EMD central banks had announced or implemented asset purchases. And this was often for the very first time. As you can see on the chart on the left here, these purchases were typically smaller than what we saw in advanced economies. For advanced economies, we're talking about 14% of GDP in terms of announced, and about 2.5% of GDP for emerging markets. And this likely reflects the different roles that these policies were meant to play. On the advanced economy front, we have basically every single economy reaching the zero lower bound, reaching the limits of conventional monetary policy stimulus, trying to overcome those limits with unconventional policies or large-scale asset purchases. In the case of emerging markets, this was more about stabilizing financial conditions during acute times of financial stress back in March. And so the natural question is, well, were these policies successful? We've done a lot of work in this report to answer that question, at least initially. So the first part is that, yes, initially these policies were successful. So what we did was estimate a standard event study of government bond yields, equity market valuations, and currency valuations, all of this around these specific events. So we're looking at the announcement effect, and then several days after the announcement of these policies, how financial variables have reacted. And what we see is that 5 days after these announcements, we have a statistically significant 35 basis point decline in government bond yields in the countries that put these policies in place. We have equity valuations rising by 2 to 4%, and we also have no statistical significant depreciation on the currency front. So that's very good news. So these surprise announcements did not lead to any type of capital outflows out of emerging markets. Now, there's many reasons to think that this may not work as well next time around. Certainly if these policies tend to be rolled out on a repeated basis. The first reason is that this was a surprise announcement, just as I've mentioned. So investors were not seeing this as a part of the EM central bank toolkit, and out of the blue, suddenly we've got emerging market asset purchase programs. So this was very big, and it was viewed quite favorably by investors at the time. At the same time, this is coming on top of essentially remarkable monetary stimulus being put in place by advanced economy central banks. So in a sense, it's pushing on an open door. Second, we don't have yet enough data to say, what does this mean in terms of the medium-term impacts on output and inflation? So the jury's still out for the longer-term consequences of these policies. And third, if we have these policies repeated in countries which have weaker monetary and fiscal policy frameworks, it could over time begin to resemble previous episodes of central bank financing of fiscal deficits. So we looked at this very closely in this current report. So we look at 5 episodes of debt monetization in EMDs in the 1980s and 1990s. And in all cases, we find, if you end up with direct financing of deficits, you're going to have significant macroeconomic instability. So it's not something where we want to end up. And for now, emerging markets that have rolled out these policies look very different in the sense that they have inflation that's relatively well anchored. The level of inflation is low. We also have the fact that many of these have very strong monetary frameworks and then fiscal policy frameworks. For example, about half of these countries that have rolled out these policies have in place explicit fiscal rules that are meant to provide stability on the fiscal debt sustainability frame. But one thing that is beginning to look a little bit like what we saw in the 1980s and 1990s is the size of the fiscal deficit. So the fiscal deficit was extraordinary in 2020, but even with what I've talked about previously, which is several years of expected fiscal consolidation, deficits are still expected to average near 5% over 2021 and 2025. And that's getting into the realm of the episodes we saw in the 80s and the 90s. So in countries without strong policy frameworks, this may be an increased temptation for central banks to ease government financing conditions. But the challenges caused by the pandemic go fundamentally well beyond those caused by the specific policies that were put in place to provide a lot of help. They were extremely helpful in cushioning the impact of the shock that we saw in 2020. So the global recession that was induced by COVID, in our view, is likely to weigh on growth prospects for years to come. Now, already over the past decade, all the fundamental drivers of economic growth, and here I'm talking about business investment, productivity growth, improvements in education and health, working age population growth. So all of these factors had slowed. And we documented this in great detail, first in our January 2018 Global Economic Prospects Report, and then after that, more recently, in a book called Global Productivity, which we released last summer. Now, these trends are expected to continue into 2020. And so using a standard Cobb-Douglas production function approach, which is a technical approach to essentially aggregate these different factors that are fundamentally important for long-run growth, we do this for 36 advanced economies and for 75 EMs. We apply this methodology and we model potential growth over the next decade, extrapolating some of the important trends that we see in the data. And what we see is that even without the pandemic, global potential growth was expected to slow by about 0.4 percentage point from the 2010s to the 2020s. And the slowdown was expected to be even larger at around 1 percentage point for emerging markets. So in the chart on the left here, what I'm talking about is the going from the yellow line to the blue bars. And as a result of the disruption caused by the pandemic, so specifically the investment losses that we've talked about, and also the disruptions on education, the accumulation of human capital, these slowdowns are likely to be increased. So on the global front, it would be an extra 0.3 percentage points for the slowdown. And on the EM front, it'd be 0.6% more. So that's going from the blue bars to the red bars. And so if we're talking about slower theoretical and potential growth over an entire decade, so the initial shock that we've showed in terms of that deep recession in 2020 doesn't just end there, right? We're talking about long-term weakness associated with that severe development. And this slowdown will cut across fundamentally all emerging market regions. And you can see that clearly in the chart on the right. Now, something important to note is that a slowdown in long-run growth prospects is typical after global recessions and also after country-specific recession episodes. So you can see this clearly in the 10-year ahead consensus growth forecast, which we can consider an alternative measure of long-run growth prospects. So after 10 years, when you think about what does it mean to have a long-run 10-year ahead forecast, well, fundamentally, all the cyclical effects associated with the shock that would happen now, like the pandemic happens last year, and it's going to continue to influence activity for several years. 10 years ahead, we're expecting these shocks to fully dissipate. So long-run forecasts should look a lot like what the theoretical potential of an economy would look like. And it's important to pay attention to these long-term growth forecasts as an indicator of the confidence that drives investment and consumption decisions. So let's take a particular example here. And on the left, focus in on the global financial crisis, which is the last global recession. So over the decade from 2010 to 2019, so it's exiting the global financial crisis, long-term growth forecasts for EMs were lowered by a cumulative 2.2 percentage points. And those for advanced economies were lowered by about 0.6 percentage point. And this is happening because year after year, you're having growth disappoint. And if we want to be more systematic about this, which we were in this report, you can look at country-specific recession episodes. And we look at 55 different countries and their recession episodes over 30 years. And what we find is that after the average country-specific recession, long-term growth forecasts were 1.5 percentage points lower in countries with recessions than those without. And the other very interesting piece of analysis that came out of this work was that it doesn't happen immediately. It's not that long-run growth forecasts are immediately changed by the shock that occurs at the time t, the year of the shock, or even the year after. It's 2 years, 3 years, 4 years, 5 years after the shock that we see these meaningful downgrades to long-run growth forecasts. Now, it's not impossible that this pandemic is different this time around in terms of the economic shock that it caused, having some productivity boosts in the future. We could imagine, for example, that our collective move out of the real world into the Zoom world, right, allowing us to avoid our commute, work from home, streamline our work processes, could lead to big efficiency gains. It's not impossible, but it would be unusual. And unless that productivity boost occurs, it's going to be up to policies to fundamentally boost growth. So you'll recognize many of these policy priorities. Many are not new, fundamentally. And for this JEP, we took a deep dive in terms of looking at the policies that have growth-enhancing characteristics. A lot of that is described in our chapter 3 of the report. And there are 3 types of policy priorities that we want to pay attention to. The first one is new priorities created by the pandemic. And obviously, the most urgent is containing the pandemic to allowing governments to finally be able to durably relax these pandemic control measures and have activity recover. Second, there are longstanding policy needs that have become fundamentally more urgent because of the pandemic. A lot of these are more country-specific, but you could imagine, improving insolvency regimes, allowing for better, startup regimes to make room for a quick recovery in many economies. And also, more fundamentally, I want to emphasize preserving financial stability. In the previous JEP, we looked at the impact on output of recessions and financial crises and combined episodes of recessions and financial crises. And what we see is that a financial crisis, if it occurs, is always extremely damaging for economic output, both in the short term and in the medium and longer term. So preserving that financial stability and doing what is needed to be done to avert a financial crisis is critical over the next several months. And third, the third policy priority bucket is longstanding policy needs that were important before the pandemic and remain important after the pandemic. So here we're talking about governance and business climate reforms, things that will help us boost private investment, especially in an environment where fiscal policy and fiscal positions are quite constrained. And if we think about that third bucket, these governance type reforms, and we combined several of them, right? A broad rollout could fundamentally achieve a lot in terms of offsetting the expected decline in potential growth. Using our production function-based potential growth approach, we model a package of reforms that could reverse the damage of the pandemic to potential growth. So if you look at the chart on the left, the 2 blue bars show the potential growth over the 2010s and potential growth as it would look like over the 2020s with the pandemic, but absent reforms. And this is the policy scenario we model. And this is admittedly a stretch reform scenario. So we assume that every EM is going to repeat their best 10-year investment growth, their best 10 years of secondary schooling achievement or improvement, and also they raise female labor force participation to close the gap with male labor force participation by as much as the top quartile of reformers. All of this together, we were talking about a constellation of many different policies that could make this happen, could boost potential growth in EMs by 0.9 percentage points over the coming decade. This is big because it would more than offset the slowdown that we're expecting from the pandemic. And in the past, investors have typically recognized in these reform advances in terms of higher long-run growth forecasts. So for the chart on the right, you can see we estimate a local projection model that shows the long-term consensus growth forecasts after reforms that would raise the ICRG type indicators. And here we're talking about investment profiles, bureaucracy quality, control of corruption, law and order. And 5 years after such reforms, we have long-term growth forecasts up by an average 0.8 percentage point. And similar, if you have big setbacks on this front, you have downgrades to your long-run growth forecasts. So to quickly summarize, we're in for a short-term outlook that's going to be subdued, and we have downside risks until the pandemic is really brought under control. And that's going to be quite a heroic effort, and it's going to take quite some time. Debt-related risks have clearly increased, as we've seen a record surge in debt. And the prospects of a decade of slower growth essentially means that we're going to erode debt carrying capacity even more. And lastly, unless we have that productivity miracle, which does not seem to be in the cards, we'll need a comprehensive push to boost growth, right, on the policy front, fundamentally, over the next decade. And since I have you here as a captive audience, let me just encourage you to look at a few more of our recent publications where we develop a lot of these points in detail, specifically our book on global productivity, which we launched last year. And it has a chapter where it looks at all of these adverse events and their impact on productivity and economic growth, things like epidemics, climate disasters, wars, natural disasters. And one thing we never see after these events historically is a productivity boost. We see years and years of productivity losses. So I think we need to temper our enthusiasms on the upside. And on that uplifting note, I'm happy to take some questions.
Yeah, thanks, JD. I'm not even sure if I recall the last time there was ever a productivity boom, maybe in the late 1990s. So I think on that front, we have a lot of work ahead of us. So no, thank you very much. That was really interesting. The World Bank does great work. And I'm going to probe you in a couple of areas to start. So first, in the distribution. The one thing, of course, we know is that the pandemic has hit the people who are the least able to protect themselves from it the hardest. And of course, when one does the growth, when one does the projection for different regions, we know that there's, as you pointed out, there's some regions that are going to be terribly hit. But I don't know if you go into this level of detail, but we know that women in particular have been very, very hard hit. That there's other groups that have been very hard hit. How's that taken into account in your projection? Is there anything you can say about that?
Certainly, Bob. So yes, we're certainly in agreement. If we think about what we're here to do as the World Bank, it's to raise living standards on a durable basis, especially for the poorest and most vulnerable populations globally. And you're absolutely right that there's heightened inequality that comes out of this pandemic, especially just the nature of the shock and the nature of work. So we know that emerging markets, for instance, have a much higher proportion of informal workers. And these workers very often do not have access to teleworking opportunities. And they're working more day-to-day laborers. They're heavily affected by mobility restrictions. Women as well, right? And as you've mentioned correctly, and that also has long-term consequences. And that's part of our long-term outlook in the sense that you have many women exiting the labor force. So bringing them back in the labor force, after this will take some time. And so all our emerging market forecasts are done essentially at a bottom-up country level, and they take into account all these different factors. And that essentially builds to the scenario that we're showing, which is a bit more conservative relative to other forecasters in terms of the speed at which some of these economies that have these vulnerabilities can exit the recession.
Yeah, it's taken economists a long time to actually acknowledge that distribution actually affects growth, or distribution of growth actually affects growth. Anyway, that's good to hear. When you go to the productivity report you guys put out in the summer was excellent. So when you go to structural reforms, they almost always disappoint. When I work at the OECD, structural reform to boost long-term growth prospects. Yet it's really challenging for governments to do that. And then some people say, well, you know what, during a recession, this is actually the best time to do it. But once again, that comes one of the that are these governance frameworks. In terms of the work you have done, is there 2 or 3 sort of types of reforms that you would say are key or critical? And maybe that's kind of what was in your table anyway, but maybe you could just go over those.
Yeah, certainly. I would say, one thing that is potentially different this time around is the amounts of fiscal constraints that these countries are facing, right? So anything that could allow us to, unlock private sector growth and boost private sector investment would be welcome. And here we're talking about specific reforms in terms of enhancing, the ease of doing business, the cutting the red tape, allowing business startups, allowing funding to be available for, new businesses, allowing that kind of younger productive firm to show up and add to the productive stock of the economy. That said, governance reforms are also very important. So fundamentally, for these emerging markets, having that political stability, that governance stability, and that leads to more than just, a peace dividend, but it's more a question of building trust of your populations in the central government. That allows, a move out of informality more into formality, right? Broadening fiscal bases, and that allows for investments in infrastructure to take place, which add to the productive stock. So I think they're relatively more tailored towards the actual regulation, red tape, and then governance reform angle. And something to keep in mind too is that, it is a good time in the sense that we've had this crisis. We realize we need stronger growth to be able to grow out of some of these problems. And at the same time, some of these old sources of growth that we've identified in the past, so for example, global trade integration, right, and GVC participation. These are great ways for an economy to grow, right, and move up the value chain. But they may not face the same opportunities over the decade ahead than they did, the decades previous. So it's really coming down to looking for new sources of growth, and domestic innovation and domestic, sustainable investment is a great way to start.
Another question for you, since you mentioned that you actually did the work on the pandemic modeling. So did you bring in epidemiologists to help you in this work? Economists tend to do their own thing, and I'm kind of curious whether we're bringing in other, experts in the area to help us in this work.
Yeah, I have to say, so going from the Bank of Canada to the World Bank, something that was absolutely striking was the breadth of expertise in the institution. So we have, extraordinary epidemiologists working with us. So we've had our colleagues in the human development part of the bank essentially weigh in on their views of what was possible for the vaccine distribution. So this reflects kind of a consensus view of what could be possible, more than it is, the siloed economist jumping in and seeing, wow, there's a few equations for an epidemiological model. I can make that work. So we have to be, we have to be very, very humble as to what we can project on the epidemiological front, and having that support from colleagues who have been dealing with this in the field for decades. Especially the World Bank has been a world leader in terms of vaccine rollouts for many other epidemics. So that's been very helpful. It's boosted our confidence in the assumptions that we've put in place.
So JD, we have a few questions from our viewers, so to speak, and one of them relates to renewable energy, and to what extent it goes, to what degree have sources of renewable energy been taken into account in future forecasting a growth? I was on a webinar earlier this morning, and someone, I think, maybe trying to be provocative, said that, while climate change as a whole is good, measures to address climate change as a whole obviously are good for the world. Some of those measures can be very detrimental to developing economies, especially those that rely on commodities. And I didn't get really into it, but obviously you need distributive mechanisms to help those countries out. But how do you take into account these different things in the forecasts?
So like I said, as I mentioned, we have these kind of bottom-up country by country forecasts, which take into account certain of these facets, especially on the energy production side. When it comes to commodities, industrial commodities, and especially energy commodities, that's a huge part of the story for many emerging markets in terms of a key engine of growth for their economies. And when we think about projecting this forward, and this interacts with the question of reform, we talk a lot about this idea of diversification, right? Moving away from the over-reliance on certain particular commodity sectors. And you have to be clear that when you think about green reforms, for example, it's great, but it also involves that transition from one sector to the next, right? So you are going to have short-term employment losses. These people leaving these high-paying jobs in an extractive sector have to find a home somewhere else. And that's why we want to pair it with all the other reforms in terms of unlocking the potential of other sectors in the economy. When we think about specific policies and going forward, a lot of what we advocate on the ground is about adaptation, right? It's about making sure that countries are in a position where they can weather the climate change that comes, right? Beyond contributing to broader efforts globally to limit climate change. So that's why we do emphasize things like green infrastructure, and being able to be more resilient long term.
Another question is, it's essentially one of your risks, but what happens if more developing countries default on their debt?
Yes, so that's a very good question in the sense that there's a lot of competing forces right now. So we're not sounding the red alarm when it comes to debt distress immediately, because we're in a situation where there's a real chance that we have the pandemic durably contained, we have growth bounce back. And in that case, we are going to see some improvement on the fiscal sustainability front. At the same time, global interest rates have continued to decline and are likely to stay low for long over an extended period, right? And so we're not in an absolute dire situation, but if the pandemic were to be more difficult to control, if we wind into these downside scenarios, especially kind of a global financial crisis, we could very much see widespread defaults across emerging markets. And the work that we've done in the past is that going through that debt crisis would be very damaging. It's a very slow process. That's why, in part, in other elements of our work, we've been advocating for a very swift resolution in terms of global debt relief mechanisms, just being able to move past, restructure immediately, get transparency, fully understand what you've lent, what you've borrowed, what can we get rid of, how can we move forward. So anything that accelerates the pace of restructuring can make a dramatic difference in terms of being able to bounce back if we ever found ourselves in that situation.
Yep, definitely. What about reshoring? Did you make any assumptions on reshoring? mean, there's been a lot of talk about this and the reorientation of global value chains as a result of the pandemic. Is that something you see as permanent, or is it transitory just in relation to how countries had to deal with the shock?
So I think there's a couple of different views on this front. I think early on in the pandemic, especially when we were talking February and March of last year, I think there was a lot of worry that we were going to see this very large, persistent disruption to global value chains. I think with the way that global goods trade has bounced back and global trade networks have been quite resilient, there's always that kind of underlying possibility of structural reshoring over time, as this kind of dividend boost that we've seen for global internationalization has come down a bit. That said, we view it more as this is an opportunity for a reorganization of some of these value chains. They may become more regional, they may become a bit simpler, but in that, there's a chance for many economies, if they want to put in place the right, the right foundations for growth and for accepting these GVC participation opportunities, to really jump in and take a role here. So it's not a zero sum in the sense that we're just going back to reshoring, but it may mean a relocation of certain value chains.
I think I'm going to guess here, but I think there are probably some students that are listening in, and I thought, perhaps you're a Waterloo grad, you're a Balsley School grad. Maybe you could say, what are when you look back to being in Waterloo, like what are the things that really helped you get to where you are today? Like what are the skills you think, or like what was it that you learned that's helped you to get to where you are? Like you've done many jobs. You had a whole co-op history, of course, but then you did a number of different things at the Bank of Canada, and now you're at the World Bank. What do you think helped you get to those positions?
Well, I think it's a combination of things. I think one thing in particular, maybe that made my my profile stand out a little bit, was that I did a dual master's. I did global governance and economics. So I did all my core work on the economics master's front, and that gave me a quantitative edge to be able to jump in on the modeling front, to understand the statistics in a bit more depth. And as we move into this kind of digital programming world, having that edge on the quantitative front can be quite beneficial. And it opens up doors in terms of the work that I've done at the Bank of Canada in terms of global macroeconomic modeling and statistical analyses and short-term forecasting. So that I think has been instrumental in taking me where I am. But at the same time, I think a lot of it has to do with building good, durable networks. In terms of professors, for example, at Waterloo had a great network in terms of who they knew, and in the public service and the private sector. So you can get some exposure in terms of talking to different people, having a sense of what a career could look like. I know personally, I didn't have an immediate vision to work for the Bank of Canada, but I was actually strongly convinced to move there by one of my Waterloo professors, Jean-Paul Lam. And I really credit him for that, putting that idea in my head, and I think it served me very, very well. So, I mean, you have to be intellectually curious, and you have to be willing to take opportunities outside of your zone of comfort. And I think long run, that becomes a very rewarding opportunity to take.
Another question came in, and I was going to ask it myself, but here it is. And essentially, I think it'll go back to your work on potential output, and probably the work that was done on productivity. But essentially, how do you evaluate the impact of new technologies, and then how do you do that and bring it into your potential output scenarios? They're very specific here. Like, we got the whole list of them. The list is very long, as you might imagine, but leave it there.
So when we think about it from a more theoretical standpoint, it can enter in a few different ways. So as I mentioned, that Cobb-Douglas approach, you have essentially a capital input, so your investment, your business investment in machines, and then the softwares. You have your individuals who have a certain level of education, and then you have your residual total factor productivity, as they call it. So basically the kind of secret sauce of combining all these elements in a very efficient manner to produce growth. So when we think about these digital technologies, they can enter in many different ways. So we have the reality that technology can bring forth better software, better machines that can produce stronger growth in the long term. As we've been seeing with this pandemic, digital technologies have been instrumental to overcome challenges of mobility restrictions for schooling, for example. So we're able to teach individuals via e-learning in a way that we weren't able to do so before, and that opens up a whole new era in terms of education. It's no longer needing to move to a specific country to take a specific course. You could imagine globally having access to the best professors and the best courses at a click of a button. And then finally, in terms of the efficiency gains, there's a lot of promise in technologies such as AI, for example, in terms of being able to identify opportunities that we weren't necessarily able to see previously in terms of efficiency. So there's a lot of benefits on all those fronts. That said, you need a lot of prerequisites to put this in place. You need all that infrastructure. You need that digital infrastructure. When we're thinking about emerging markets, we're still trying to boost, basically internet participation, access to mobile phones, access to high-speed internet connections. So there's going to be some natural limits to this process of digitalization that's imposed by the infrastructure and everything else that's needed. Just the regulation, for example, to be able to have a safe online experience, to be able to do payments and transactions online. So we're thinking about all those dimensions, but fundamentally we'll need progress on all fronts if we want to see that durable quickening of growth.
Yeah, I fully agree. I just wrote something for Fiji that was pretty consistent with what you just said. Well, I think we've run out of time, so I'd like to thank you very much for taking time to talk to our community today.